Hello and welcome to AI Market News by LM. Okay, let's dive right in. The big story that's got the entire financial world talking today really boils down to just two words: a simple response from the White House when asked about the next Fed chair. Tomorrow morning. And just like that, that single phrase kicked off a massive market reaction. Why? Because reports immediately started firming up around one very specific candidate. And that brings us to the main event, the expected nomination of Kevin Warsh. As soon as this news hit the wires, we saw an immediate and frankly widespread reaction across pretty much every asset class you can think of. You could literally see traders everywhere scrambling to price in a whole new direction for US monetary policy. So let's look at the instant replay. US equity futures, especially the tech-heavy NASDAQ, took a tumble, dropping about 1%. At the same exact time, the US dollar index shot up 0.5%, and the 10-year Treasury yield jumped all the way to 4.3%. And, as you might expect with a stronger dollar, precious metals like gold and silver got knocked down. So what are we looking at here? It's a clear split, right? A stronger dollar and higher bond yields on one side, but stocks and gold getting hammered on the other. So what gives? Well, it all comes down to one little word that is shaking up the markets right now: hawkish. To really get what's happening, we have to understand how the market sees Kevin Warsh. He's widely, and I mean widely, seen as a hawk. A hawkish policy basically means your number one priority is crushing inflation, even if it causes some pain. And that usually means higher interest rates for longer, and definitely being in no rush to start cutting them. And look, this perception isn't coming out of nowhere. Warsh has a long track record. He's been a very vocal critic of the current Fed, even calling for a regime change. The market sees him as someone who'd absolutely prioritize inflation over the job market, and he once famously said the Fed needs to, and I'm quoting here, break some heads. Yeah, that's not exactly a soft and gentle approach. So it's no surprise that this tough on inflation stance immediately translated into a rally for the US dollar. Traders are basically placing bets that a Warsh-led Fed means higher US interest rates are coming, which makes the dollar a much more attractive currency to own. And of course, that dollar strength had a major ripple effect across the globe. We saw the euro get weaker against the dollar, and the Japanese yen also took a significant hit as that dollar rally gained steam. It's a classic currency market reaction. This whole situation is a perfect illustration of that inverse relationship we so often see between the dollar and US stocks. Think about it. A stronger dollar makes American goods more expensive overseas, and the threat of higher interest rates can really squeeze company profits. That's exactly why we saw all that pressure on the NASDAQ, which is full of growth-sensitive tech stocks. Okay, so that's the play-by-play of the immediate price action. But what's the overall mood? What's the sentiment out there? For that, we can take the market's temperature by looking at the Fear and Greed Index. And right now, the needle is pointing to 42, putting us squarely in the fear zone. This tells us that today's news has definitely made investors nervous and more risk-averse. They're pulling back from riskier bets and looking for safer places to park their cash. And if we pop the hood on the index, we can see exactly what's driving this fear. It's mainly two things. First, market volatility is on the rise, as nobody's quite sure what the Fed will do next. And second, there's a big jump in safe haven demand. That's all the money flowing out of stocks and into the perceived safety of the good old US dollar. So, with the market now trying to factor in a much more hawkish Federal Reserve, all eyes are shifting to the next big data point. Let's pull up the economic calendar and see what's on the radar. Looking at the economic calendar from investing.com, the one release that everyone is going to be glued to their screens for is the Producer Price Index, or PPI, dropping at 8:30 a.m. Eastern Time. This is a huge measure of inflation at the wholesale level, and given everything we've just talked about, it's going to be watched very, very closely. This number is now absolutely critical. The big question, the one on every trader's mind, is this: is this inflation data going to come in hot? Because if it does, it could give a hawkish nominee like Warsh all the reason he needs to push back on any talk of rate cuts. Whew, okay, that was a lot. So let's take a breath and quickly run through the key takeaways from this whole market shakeup. So, to recap, the catalyst was the news about Kevin Warsh potentially becoming the next Fed chair. The market's reaction was a classic hawkish repricing. We saw the dollar and bond yields go up while stocks went down. The reason for all this is Warsh's reputation as a serious inflation hawk and Fed critic. And as for what's next, it's all about that US PPI inflation data. That's the next chapter in this story.
Now for our disclaimer. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
And there you have it. This event really sets a new tone for the markets as we head into February. All eyes are on that inflation report. Thanks for watching. Don't forget to like and subscribe.